all the leaders, and do join us for the upcoming session. We have with us Mr. Keki Mistry, who's joined us for a power-packed keynote interview. Can we have the guests online, please? I'd like to invite our moderator first, Mr. Chirag Gandhi, the Joint MD and Co-CEO, Axis Capital. Chirag has more than 18 years of experience and has been a part of Axis Capital since inception, having held various positions. He's been a key resource and has been highly successful in sourcing and executing mandates. Welcome, Chirag. I think
Yeah, hi. Thanks.
Okay, Chirag. We are very honored to have Mr. Keki Mistry with us, who's the Vice Chairman and CEO of HDFC Limited. I'm not sure what more can I say. He's highly regarded in the banking and financial services industry. He brings with him nearly 4 decades of varied work experience in banking and financial services domain. He's played a critical role in the successful transformation of HDFC into India's leading financial services conglomerate. Amongst the various recognitions that Mr. Mistry has, he's been awarded the CEO of the Year under BFSI category at CNBC Awards CEO Awards 2019. Welcome, Mr. Mistry. Very proud to have you here with us. I'm also very pleased to welcome Mr. He's the managing director in real estate group at Blackstone. Now the biggest landlord in India, and who have backed not only the first successful REIT, which is Embassy REIT, but also the second one, the Mindspace REIT, which was a super success during the pandemic. This only fortifies the belief of the investors in India's growth story. Welcome, Vikram. Very pleased to have you. Last but certainly not the least, Mr. Neil Raheja, who's the Group President, K. Raheja Corp, also Chairman, Naredco Maharashtra, and Chairman of Aprilia India Chapter. Neil has been instrumental in the policy advocacy at various levels with the government, has over 21 years of experience across real estate, hospitality, and real estate industry, and recently tasted success with the Mindspace REIT. Welcome all of you gentlemen, and over to you, Chirag, to take forward this. Thank you.
I think Chirag is having some trouble, but I thought, why don't we start, Keki, with you, if I may. You know, you're at the center of the whole financial services and real estate industry action. And it'll be great to hear from you on how are you seeing things in the economy, what's happening, across sectors, and more particularly the real estate sector, and what is your perspective of it going forward?
I said when the pandemic first came about in March, we did a number of calls with our investors. And at that time, our sense was that with every quarter, things will keep getting better. But it would not be till the beginning of the fourth quarter, till the Jan to March 2021 quarter, before we can even remotely get to a level which is close to what we were in the previous year. That was our belief in March, April. Fortunately, things have we've been proved wrong. The growth in the economy, the growth in the real estate sector included, has been so sharp and so sudden that frankly, it has taken us by, it's been pleasantly surprising for us. If we look at our business, in October, we had a 35% growth in our individual loan disbursements compared to October of last year. And in September, we had a 7% growth compared to September of last year. So growth has picked up in the economy. People perceive that this is the best time to buy a house. First, for the reason that the interest rates are probably as low as they will get. In my view, the ability of RBI to cut rates going forward will be very limited. Secondly, there are various concessions that different states have given in the expectation that by giving a boost to the housing sector, effectively will give a boost to all the core sectors in the economy. Cement, steel, paint, power, and all these industries will be a beneficiary if construction activity picks up. Also, housing directly brings about a lot of jobs whether it is construction workers, masons, carpenters, plumbers, engineers, and so on and so forth. So by giving a boost to the housing sector, you'll give a boost to the core sectors in the economy, you'll create a lot of jobs. Jobs will lead to consumption. Consumption will lead to more manufacturers leading to produce more. And that is really what gives the economy a big boost. So to that end, various states have tried to do different things to try and give a boost to the housing sector. For example, as we all know, in Maharashtra, the stamp duty rate has been lowered from 5% to 2%, provided the transaction or the registration is done before 31st December. So I think more such measures taken by local state governments will help in giving a further boost to the real estate sector. But coming back to the economy, economic growth, economic pickup has been significantly better than what anyone would have expected in March, April.
Thank you, Keki. Neil, I'm going to take, I'm going to have you take the next question. Do you really think, given all that has been done, that the residential segment or the residential space has really revived now? Is the revival for good, or is this something that what we've seen in October, November, just a flash in the pan and something that we should not expect to sustain?
Thanks, Chirag. Very good question. So clearly, the residential sector has been going through a tough time for the last few years. But I think what's changed, that we've had few months of near zero sales, and that some of it is pent up demand which had come back. But on the larger sense, what we're seeing is that people have realized the value of a good quality home. If they were willing to upgrade and have money, they buy a smaller apartment. Some people were also saving, moving to suburbs for larger spaces. But I think essentially the value of the home has become pretty important and center of this. The second big change is I think we've seen home loan rates coming to the lowest levels in 15 years. Along with the fact that you have a stamp duty cut, you've had affordability because prices have not gone up for the last 10 years. So this has made it a very interesting opportunity to see volumes which are starting out. And I would believe for the next year or so, we will see a volume increase continuing. And I don't think this is here in the short term. The only red flag I would put is if developers think they can increase prices at this stage, I think you will see a decline in volumes with that. I think right now it's going to be more of volume, and which is really what the industry needs, which is what the larger economy also is required.
Okay, thanks, Neil. Vikram, the next question is really for you. I know you guys don't do as much in the residential space, but I just wanted your views on non-conventional real estate assets, warehousing, industrial and data centers that are gaining prominence today across the country. Do you see investment opportunities in these sectors going forward? Do you believe it is time for a REIT in these segments, for a debut of a REIT in these segments?
So Chirag, yes, I think good question. I think, logistics has honestly been a large investment theme for us globally. It's a sector that we kind of went in quite strong. And I think in the last, I would say 10 years, we kind of built a portfolio of 1 billion square feet across the globe. We just closed something in China, which is the largest logistics park. So I think, yes, it's a sector that given what's happening with e-commerce, the GST regulation, it is something that we expect will see a lot of significant investments over the near to medium term. Similarly, with data centers, given the changes in laws around, localization of data, the internet penetration, etc. I think that's another sector which has taken a lot of interest, and it's a sector that we are watching closely. I think clearly these are early days for, let's say, I think logistics obviously has seen a bunch of investors who've come in. Data centers also are starting to see investments happen. But I think we're very early from a REIT perspective. I think it's we just need critical size right now. It's important that some of these sectors kind of grow, as we've seen globally, and some of the two REITs that are out there, and what we've seen globally as well is you need a deep kind of, capital pool. The size, there needs to be liquidity in some of these products in order to gain fancy of investors, both globally and domestic. So while these sectors is interesting, and I think we'll see investor interest, I think it's too early from a REIT perspective.
Thanks. Keki, this is one that I've been wanting to ask you personally as well. And it's on funding and interest rates. How do you see the availability of funding and cost of funding for both residential and commercial segments? we're seeing lending rates at one of the lowest levels in the past 2 decades for individual home loan borrowers. Can we expect some respite for the builder segment also, the way we've seen in the retail mortgage category? And more so on the commercial side, how do you see the funding environment post the REITs? We've seen rates have come down some. I know Mindspace has raised 500 crores at a 6.8% bond. Is there room for it to go lower? What can be done to introduce more sustainable source of lending? And how can we improve the access to the bond markets for real estate?
Well, I think firstly, you said that the interest rates are the lowest in the last 2 decades. I don't think that's correct. I think interest rates are the lowest they've been in the last 4 decades. I've been working in HDFC since 1981, and since 81, I've never seen an interest rate of 6.8 and 6.9%. That's one. Secondly, will there be scope for further cut in interest rates by the central bank? In my personal opinion, the way things are looking now, the kind of economic revival that we are seeing, my sense is that over a period of time, maybe not today, maybe not 1 quarter or 2 quarters later, maybe 4 quarters later, 5 quarters later, you could perhaps start seeing some pressure on inflation coming about. Because if there is economic activity happening in a big way, it has to at some point of time start leading to higher inflation. And if you do get higher inflation, or if RBI perceives that there'll be higher inflation, then the ability of RBI to cut rates going forward will be very limited. But having said that, over the next 6 to 9 months, maybe 6 to 12 months, I expect the benign interest rate environment to continue. I would expect RBI to continue infusing liquidity in the system like it has so very well done over the last 7-8 months. I know a lot of people were very nervous and very worried in March and April because liquidity was just not available to many of the players. But RBI, I must say, has done a very commendable job in ensuring that every segment, every part of the market gets liquidity. What has happened over the last 8 months is that markets are clearly distinguishing between the stronger players and the weaker players. So it's not like 2007 or let's say 2015, for example, or 2016 or even 2017, for example, when whether you were AAA or you were AA, the gap in your lending rate would have been very, very minimal. Now the markets are distinguishing between top quality borrowers and not so good borrowers. And therefore the interest rates are a function of what the perception of your credit is. So I think what developers need to do, in my view, at this point of time, is to ensure that the stuck projects, unfortunately, developers have earned a little bit of a bad name, some of the developers at least, because of the fact that you have so many media articles which have consistently been written over the last couple of years and analyst reports about the excess supply in the market and the oversupply in the market and why property has been left incomplete and things like that. So I think that image has to change. Once that image changes, developers will automatically be able to access funding at a lower cost than what they are doing today. I think the good top quality developers will even today be able to access money, not at 6.8 or 6.9%, because the risk premium on a developer loan, even from a prudential perspective, is higher than what it is for an individual, but at relatively good rates. But the weaker developers will find it difficult to raise money unless they improve the quality of the balance sheet. It's so very critical for developers not to be over leveraged. It is something which keep telling people that don't just keep borrowing money. And if you have 5 projects and 6 projects, and for each of these 6 projects you've gone and borrowed money, you just created so much of a leverage that it doesn't when any lender looks at the balance sheet of the developer, it just doesn't look good. So stay well capitalized is my advice to developers, and control the amount of leverage that you will take.
Thank you. Just to follow up to that, Keki, do you then see consolidation in the space becoming real? I mean, if the larger developers now have far significantly easier access to capital, do we really see consolidation playing out even further in the space?
I think consolidation can happen and should happen. The problem with consolidation is that the consolidation happens at a project level and not necessarily at the entity level. Now, at the project level, when there is consolidation, there are a lot of issues which you still have to go through. You're perhaps better conversant with these issues than I am. You need approval of the lenders, you need approval of the flat buyers, you need approval from regulatory authorities, RERA, government, and so many things. So that process takes a very long time. But otherwise, that is really the best way forward, where bigger developers don't start new projects, but just take over projects of existing developers which are stuck, get those projects completed, get it at a much lower price. Someone will have to take a haircut in the process, but so be it. But at least the community, the developer community, will earn a good name if all these so-called stuck projects get completed.
Thank you. Neil, I know this is a question that you've been asked a lot. The impact that you see on from COVID-19 and all of the work from home on just commercial demand and how leasing is shaping up and rent collection is shaping up post-COVID.
Thanks, Chirag. So I think two good questions. On the rent collection side, let me start with that first, is, we've seen quality tenants pay pretty much all of the rents. Our rent collection we announced was 99%. I think most commercial developers are north of 95. So I don't think there's been a challenge in rent collection at all. I think the only ones who don't pay are the shops or restaurants which were shut for that period, and then they needed some time to come back. In terms of work from home, as we're right now doing, as we would have normally been in a conference hall, most of us are still, many of us are working from home, some of us in the office, like I am. But, since people haven't come back to work, the new leasing activity has been slow. But if you look at the commercial market in India, most of it is global back office, which takes place or is outsourced to India. So what we're seeing is two things. One is people are saying that, can we shift some offices from CBD to suburban offices? So some of that trend has started for domestic companies saying, can we go from Nariman Point, Worli, BKC to, say, Navi Mumbai? So this is one trend we're seeing to save on rent. The second trend, people are talking about saying, can we make it 80% and flexi seating or 90% and flexi seating? There has conversations happened on that, but nothing really in place yet. But I think the biggest change we've seen is most of the demand, 75-80%, comes from global companies. And having worked from home for 8 months, these are CEOs who thought that they could not shift businesses, people from Midtown Manhattan, London, Hong Kong to India. Now they've realized that they worked 8 months outside the office. The fact is the cost saving for them is as 80% cost saving. And there is a very compelling reason to cut cost and shift it into India, because you're getting better talent pool at a significantly lower cost. And the rental cost of that in India is only about 4% of the total cost. I think the reason they're doing to do it and shift it to India is because of the cost saving. Already, most of the global large multinationals like Goldman Sachs, JP Morgan, and Accenture CEOs have come on record and said that you cannot work from home long term because it doesn't work well for innovation, for team building, for organization culture. And after 3-4 months of working from home, they're seeing a significant decline in productivity. And therefore, most of their top management has started coming back already.
Okay, thanks, Neil. Vikram, as large owners of real estate, as a fund in India, any lasting adverse impacts on COVID that you see on the office sector?
So I kind of echo a lot of Chirag, Neil's sentiments. I think we're obviously still not out of the pandemic yet, and things are going to evolve. I think it's going to be a function of how soon and in what shape the vaccine comes and how accessible it is to people. But I completely echo Neil's sentiments. I think ultimately people will come back to office. I think people may have some flexibility in what they show to their employees. You could have a central office and a suburban office. But I think at the end of the day, I think, as Neil said, the office is a place where people come and collaborate. You kind of build a culture in an organization. You need talent to kind of be, mentored, etc. So our belief is that, ultimately people will come back. And specifically for India, I think, a lot of our talent are people who are like in the 20s, who don't necessarily have all the physical infrastructure. I think probably a lot's already spoken about it, so I'm not going to belabor some of these points, but the physical infrastructure, more importantly, the social infrastructure. I think a lot of the young talent kind of see the office, and we've seen that a lot of CREs or CIOs or CEOs that we speak with are essentially saying that these offices are really a big ecosystem for a lot of these talent. And, you've got food, you've got cafeterias, you've got play creches, etc. And that some of those, I think, benefits outweigh the real estate cost, which in any case is, as Neil said, anywhere between 4 to 6%. Also, the fact that technology, there's been the technology sector has obviously kind of grown through this crisis, and I think we already started seeing a lot of that work happening in India in the last decade, where we've really moved up the value chain. And I think more of that's going to happen now. I think you're going to definitely see more digitization, artificial intelligence, emphasis on all of those. And India is obviously at the forefront of having the talent, the right infrastructure now. So I think our belief is ultimately things will come back. It may take a little more time for things to normalize. We're starting to see even global companies allowing people to come into offices in very, very small numbers in India, but hopefully things improve.
Thanks, Vikram. Keki, the next one's for you. Just your thoughts on the NPAs in the banking system post what, if we were to believe that there will be consolidation and therefore the advent of corporate developers expected to strengthen further, plus all of the one-time restructuring that the government has spoken about. Do you really think that we will now see a fall in NPAs for the banks, especially coming out of those that are emanated from the real estate sector?
Well, first of all, the restructuring may not necessarily help every developer, because not too many developers will be able to meet the criteria which has been laid down in terms of meeting the various ratios, which is a requirement, and getting the credit rating. So there are two challenges. One is getting an investment grade credit rating, and the other is meeting those financial ratios which are required. So that's a challenge. I think the good part compared to where things were 6 or 8 months ago is that demand for real estate has picked up. Demand for residential properties have picked up because, as I said earlier, most people are beginning to believe, and rightly so, that this is perhaps the best time to buy a property, both in terms of affordability, or in terms of interest rates, or in terms of prices. Property prices really haven't gone up in the last 4 years. And I agree with Neil that the ability of any developer today to increase prices and still get a lot of sales at the moment is very limited. So therefore, I think my sense is things look much better today than what they did 6 months ago. Is the worst over? Difficult to say. Whether NPLs will straight away come down or not, I don't know. I don't think it is going to be that easy that suddenly overnight NPLs are going to come down. You might even see a slight inching up of NPLs in the real estate sector, not significant, but slight, in the coming 1 or 2 quarters before things stabilize, let's say 2 or 3 quarters down the line. But if the important thing is, number one, this demand should continue. And number two, we should not get a second wave of the pandemic as some of the European countries have seen, and also the northern part of the country has seen. And you should not have another major lockdown. So these are the two caveats. If these two are not there, then my sense is over a period of time, NPLs have to logically come down, but not immediately. It will take 3-4 quarters at least.
Thanks, Vikram. Just your thoughts on how you're seeing, given that you're hello.
Yeah, I can hear you, Chirag.
Blackstone India is, of course, amassed a significant share of retail assets in this portfolio as well. As the dust on the pandemic settles down, there will also be rising demand for co-working spaces that offer flexibility in terms of commitment and cost to the occupiers. How do you think about some of these worst-hit sectors going forward?
Yeah, it's a good question, I think, Chirag, and I think Neil touched upon it, I think, briefly. I think, tenants are obviously at some level looking for some amount of flexibility, and I think for the co-working space, this is obviously a good time. I think they obviously provide, they provide some flexibility to tenants, which is what they potentially are looking for, where you can provide solutions not only in various parts of the city. So you have a midtown, your suburban location, downtown, all of that. I think, and so, as developers or large owners, I think in some way we used to provide incubation facilities for some of our tenants who kind of tend to grow in our campuses. I think the co-working kind of does that for us. So, a lot of us as institutional owners or for developers of large parks. Anyways, in some shape or form, kind of have those. But standalone also, I think there's no better time for the co-working players right now. I think they will have to rejig their business plan because a fair amount of capex that they need to spend upfront. So they'll have to solve for that. And they'll obviously need strong balance sheets, I think. And that's something which I think, unfortunately, a lot of the Indian players and even global players have had a little bit of problem over the last 12 to 18 months. But our sense is, I think it's something that is the need. I think tenants will demand for it. We're definitely seeing it in some of the co-working investments that operators that we've invested in globally. Having said that, I think they obviously are seeing some stress right now. They will have to wither this kind of crisis for the next, whatever, 6-9 months. But hopefully, if they shore up their balance sheets, it is something that I think they can capitalize on.
Neil, though labor in India is reasonably cheap compared to global standards, dependency on the human workforce tends to impact the pace of construction, thereby affecting the overall cost of the project. Do you think it's now time to deploy advanced technology in construction to reduce the time and costs, both on the resi and commercial side?
Very good question, Chirag. I think technology changes have already been coming in reasonably quickly in India as well. The cost differential of technology is not that high. Yes, labor was relatively less expenses as a percentage, but we also had a high interest rate cost, and that made us want us to finish buildings a lot quicker. We've seen steel construction, we've seen prefab construction. All of these have come, but I think in some places or a lot of places in India, the cost of some of this has been higher than what is affordable by especially residential developers. And therefore, it's not been as prevalent across the country. And the fact is that, there is a large component of youth who are underemployed or unemployed who need jobs. And therefore, the labor is available. Even now with the pandemic, all the labor has pretty much come back. So, the changes are happening in some parts, but I think it will move a lot quicker going forward as
well. One question that I, probably want all of you to answer, and I'll start with Keki, and then Neil, you can go, and Vikram last. If you can share from the learnings in the last 7-8 months, what contingency plans do you have in place for, God forbid, another pandemic or the next COVID? And just to get through, even to get through this one and come out successfully.
Shall I go first? I'll just take a couple of minutes.
Sure.
One is we had the reliance on digital selling of loans is something which was not so prominent prior to the pandemic. So clearly that is a change which has happened. We have an online digital platform for both loans and for retail deposits. For deposits and loans, we have been having it for a long time, but we really worked on it during the course of this pandemic. So we have now set up virtual offices. So these virtual offices means that you just have a presence of one person and everything is done virtually. Our website is there in 7 languages. We have organized online property exhibitions. We have launched a builder portal for developers to initiate online project approval. And we've set up a special strategy team, which will look at how we can improve our IT systems and how we can improve our digitization. So that's from the lender's perspective. From a developer's perspective, I think the important learning, and not just COVID, but even pre-COVID, is what I said earlier, that just keep your balance sheet, strengthen your balance sheet, bring in more equity, do not over-leverage. Just do not over-leverage. The markets will reward you for not over-leveraging. The more you leverage, the more the pain you will face in the days to come.
So, yeah, I actually completely agree with Keki. I think the biggest lesson was to make sure you keep leverage levels low. We did raise capital for the REIT, but we were anyway, we weren't over leveraged, or we were well capitalized in the commercial business. We had raised capital in the hotel business. Our retail business was debt free. So I think that helped us come through this pandemic. And I think leverage levels is very critical to be well capitalized. I think the other change we saw is we became a lot more efficient. We found that there were a lot of inefficiencies in the system, which we were able to pull out. And across businesses, whether it's our hotel business, retail business, I think at 75 or 80% revenue, we should be back to similar levels of profitability. So that is another big learning. Again, as Keki said, the whole digital space, none of us thought we could do reviews, meetings virtually, which has been done successfully for a while. We hired a CEO of Shoppers Stop all online. None of the remuneration committee had met him physically. I only met him the day he joined physically after it was all selected. So these are things which none of us thought was possible. But we have put a bigger emphasis on our online, whether it's our retail business and this thing, it's significantly ramped up our whole online experience. And the other thing we're seeing is, we were, as I said, this whole cost cutting where people want to be closer, live closer to work. We found we did a study with most of our staff. They all prefer to live closer to the eastern suburbs in Airoli, New Bombay. So we're shifting some of our offices over there because there's a big differential in cost and it's a big time saving for people. So these are some of the changes we've seen happening with COVID.
So Chirag, I mean, I'm not going to believe, again, I think both Mr. Mistry and Neil touched upon it. I think getting liquidity was super critical in times like these. And I think we've seen that in past crises as well. But I think the other thing that I would add is that I think we've kind of looked at every business of ours and see what really needs to change out there. I think on the office side, I think it's important as responsible owners is to kind of ensure that we have, we really think about our operational measures that we put in place to think about the employees of our tenants and really give them confidence that the environment is kind of safe for them to come back. And I think that's going to be a lasting impact on the real estate sector is how, there was a decade back where RFP started happening, where you put in stuff like, having creches, gyms, etc. I think you're probably going to see the next 5 years where people are going to focus a lot more on safety and hygiene and stuff like that. So that's something which we've had to do both on our office and retail and hospitality businesses. On retail, I think we'll along with our retail partners, I think we'll have to think about what's relevant from a shopper's perspective. I think there's no doubt that e-commerce will continue to grow. We still believe that in India, retail will continue to remain extremely relevant given the purchasing power, the growing middle class, the fact that, we don't have the grade A stock that we've got in India is still so relatively low compared to what we've seen in other developed markets, including, and in China. So I think what we definitely are evaluating as to seeing what are the sectors or the retail classes that will kind of get impacted. And then I think we'll have to work very closely with our retail partners to kind of rejig what we call the tenant mix in our mall. So, but I think for paramount is to ensure that, liquidity, get our employees, tenant employees, as well as customers back in our properties.
Keki, just one last one for you. I know you touched upon the one-time restructuring and one-time debt restructuring, and I just wanted to know your thoughts on if there's anything you would do differently or you would have suggested to be done differently, since you mentioned that a lot of the developers may still not be able to go for the one-time restructuring. What, to your mind, just your broad thoughts on the scheme as well as what you suggest could have been done a little differently.
Well, I think the first thing that the rating, getting a credit rating for a developer at the investment grade for a project which is stuck is going to be a challenge. And maybe that requirement could perhaps not have been there. And instead of having that requirement, you could have had the board of that company approving it or something along those lines. That perhaps could have been one of them. The other is a lot of these ratios are largely designed for manufacturing companies, hotels, industry, not really for the real estate sector. So we could have had a different set of ratios for the real estate sector. I think these would be my two suggestions that I would have given.
Neil, your thoughts on just how you see as a a REIT owner now with a listed REIT. Vikram and you, the only two are sponsors of the only two listed REITs. How do you see costs, credit costs moving down, or how do you see them playing out going forward? I know if you could just share some of the experience of bringing the REIT to market and some of the difficulties that you face there, and also how you're seeing the credit costs play out for you.
Thanks, Chirag. Very good question. So, it's been an interesting journey. We've both Vikram, Blackstone, and us have been involved in working with the government on helping the legislation come through. And, this was all our learnings from what's happening globally. I think if I'm not mistaken, close to 70% of the real estate market listed worldwide is through the REIT market. About 10 odd percent probably would be residential, 10, 15, if I'm not mistaken, and the rest would be mixed use development and rental players, which is mainly Hong Kong. Over there also what we realize is that the world is right now chasing stable income, whether it's real estate or infra, InvITs or REITs. If you look at what's happening in global interest rates, and as Keki rightly pointed out, the interest rates are lowest in 40 years, is people who are savers are not getting interest rate because inflation worldwide is low and interest rates are extremely low or negative across the world. And if you look at the other end of the stock market, the volatility has gone up significantly. Price earnings are very high and it's extremely choppy. So this has become more and more a large investment class globally. And we saw the global fund managers understanding it and wanting to come in. Initially, there were challenges. I remember Embassy Blackstone having to explain to local mutual funds on what this product is, and we did a little bit of that as well. And we were fortunate that most of them came into our IPO having understood a little bit about it. They're still reasonably skeptical. But the biggest positive change is that domestic individuals found it a great investment class. Earlier, people were buying a small shop and giving it on rent, and the tenant goes away, you're stuck, it's illiquid, high risk. Similarly, they bought a residential apartment thinking it'll appreciate, and we've known what's happened on appreciation in the last few years. And therefore, this has become a very large domestic opportunity for individuals to invest in. You get yield, it's tax-free, and it's tradable. Much easier to come in and come out, which was not an avenue available. So I think this is going to become a big savings instrument going forward, and it's going to be a critical part of the real estate investing community other than the stock markets.
Thanks, Neil. It looks like we're running out of time, so a big thank you to all of you. The last 8 months have truly been unprecedented, and it has been, like the topic says, a rejigging. While activity has been at an all-time high, we do hope this is sustainable with some of the changes the panelists have alluded to, such as consolidation, digitization, new avenues of funding. I'm sure the brighter days are ahead for the real estate space. I guess I'm going to hand over to Neetu now. Neetu, over to you. Thank you so much for this.
Thank you so much, Chirag. I would quickly want to welcome Mr. Ashok Manani, who's the president, Naredco West, and founder, Ekta Group, to thank all the guests. Ashokji.
Yeah, so Keki sir, thank you for all your insights. You've been, so very important for us, these panelists, all your panelists here. If I club the experience, it's more than a century of valuable experience that, we got to hear, our reviewers got to hear today. It's so important, as you said, to be as low leverage as possible. Thank you, Neil. You've done a great job. Your REIT has been oversubscribed nearly 14 times, and it's indeed a very, very good, asset class, as you said, investment asset class for people who really want to put in money. Thank you again, Vikram, for enlightening us on how you need to build the confidence, in the employees who are the tenants, who are going to be tenants of our spaces. Thank you, Chirag, for moderating the session. It's been a really eventful session, and you've got one of the best panels in the entire summit. Thank you, everybody.
Thank you so much.
To everyone. Thank you.
Thank you.
Thank you all the guests.